Hi, welcome to the COVID-19 market update video. This was shot on Monday, April 6th, 2020, and we interviewed Greg Rand, who is the Chief of Strategy at Renters Warehouse, which has about 22,000 units of single-family homes under management. They have a very unique perspective on what to do right now, and this interview is a live Q&A that we did with our Inner Circle group, our 80/20 Investor Academy, which is our high-end paid group of investors that are scaling and systemizing their business. If you would like more information about what's happening right now and how to shift your business, then click on the link in the description below to get access to a panel replay that we did with Kent Clothier, with Jack Bevere, Blair Halver, John Martinez, the sales trainer, and Nick Perry about how to really shift your strategy right now and make sure that your business is safe and protected and will thrive and come out stronger at the other end of the uncertainty that we're all facing. So I hope you enjoyed this interview with Greg Rand. He has a super high level view as to not only what's going to happen in 2020 with the economy, but how to prepare your business and how to shift your real estate investing strategy to focus more on protection and wealth building. So I hope you enjoyed this interview. Click the link below for more expert guidance on what to do, or you can send an email to info@investorfuse.com and we'll happily point you in the right direction for anything that you need. Enjoy. So yeah, thanks again for coming on, Greg. Last time we talked was beginning of last year, 2019, when times were a little simpler.
Yeah.
And we were talking about like what's going to happen in 2019, and for the most part, what you said was exactly what happened, right? It's just like really no signs of slowdowns or anything like that. And I even remember at some point you said, like, barring any unforeseen external event, things will go on as steady. And
I actually put a bet out on LinkedIn that I bet anybody who wanted to take it $10,000 there wouldn't be a recession in 2020. Luckily, nobody's called me on it at this point.
Yeah. So just some context so you understand the group that you're speaking to here. This is the 80/20 Real Estate Investor Academy. This is essentially just a high-end group of investors that came from the InvestorFuse, just regular software subscription, and general Inner Circle. And we're all working together to help grow our businesses, systemize our businesses, hire out a team, and scale things up. And as you can imagine, over the last couple of weeks, there's just been a lot of how do we shift our strategies? What's going to happen? We're just sort of making guesstimates as to the macroeconomic effects of things. And last week I said, you know what? Let me just reach out to Greg and see if he would help us sort of understand the second, third, and fourth order consequences of what's happening right now, so we can at least sort of make plans and try to somewhat accurately predict the best positioning to take as a real estate investing company.
Awesome. Well, that's flattering that you thought of me. I really appreciate it. I hope that I can add some value today.
Yeah, for sure. So we have a nice group on here. Probably some more folks should be joining us here soon, and this will be recorded, and I'll probably actually I might go live here. Carlos, do you have the ability to go live in our HQ channel? I think we said we would do that, right? Looks like Zoom has a new.
Yeah, I might hop down to my computer, which I'm a little bit more dangerous on than my cell phone on the roof.
All right. Well, you know what? I'll just do the live from my end, and then we'll get rocking. How do you go live on this new Zoom interface?
Is there the three dots option where it says more?
No.
Let me go hop on my laptop real quick.
Yeah.
Yeah, I actually haven't gone live on the new interface yet.
I think you have to do it through Facebook, don't you?
Yeah, but
Or something
there's a connection point in Zoom.
Try the little arrow beside where it says start video, maybe there. Video settings, I'm not sure.
Yeah, it doesn't exist anymore. So it might just be on. Carlos is the host, so we'll just do that here.
It's probably.
Yeah.
Let me see.
That makes
So
sense.
this is an open format Q&A. I'll start with the first question for you, Greg, and then we'll just keep it conversational and open up the floor. This is your guys' opportunity to really understand what's happening from one of the best voices and opinions that you could possibly get. Quick intro on Greg Rand. He runs strategy for Renters Warehouse and Own America, right, Greg?
Well, they bought Own America, so it's all one thing now. Yeah.
Right. Okay. And Renters Warehouse is essentially just a giant property management company, and you also have a portfolio, right?
Yeah. Well, that's what Own America was. It was an online marketplace for single-family rentals, focused mainly on portfolios. When Renters Warehouse acquired us, the concept is that we're a full-service real estate investment firm for SFR. So we want people to use our technology to research and plan, and then our brokerage people to execute and acquire, and then leave the keys with us, and we'll manage it. And it's our goal to help as many people that want to build a portfolio starting with one. Could always ever only be one. Could be two, could be 50, could be 250, right? But we just think the asset class is so spectacular that we're trying to make it easier by integrating more moving parts into one place. And I love the strategy side because it's, you can really let yourself, you can geek out about choosing real estate markets and playing mega trends about the migration of people and different parts of the country that are elevating at different times. And, people can really get, and I know the people on this call are definitely part of that, where you get your own intuition, your own original research, and execute a completely original strategy on building a portfolio. And if you do it well, if you do it average, you do really well over time. Right. If you do it well, it just becomes a family legacy kind of thing that, they've got your, everybody in the whole family's got your painting over the mantle.
Yep.
Because you hooked everybody up.
Yeah. So you help folks build their portfolio starting with the first property and all the educational side of it as well. And property management.
So yeah, I mean, education and real estate investing is definitely popular, right? So we have a point of view and a way of expressing it that's a philosophical thing. I named my company Own America because I think that's what you're doing when you're accumulating real estate, right? You're picking your bits and pieces of a footprint of ownership of what I think is the best product, if we could call it that, known to mankind. The most in demand being insatiable. It's you get to own a piece of this country, which is amazing.
Yep.
All the benefits of it that we know about, it begins with this idea that shelter housing in this country the fact that you can own it is phenomenal, and so you should. Yep. It's just hard, right? And the industry that sells real estate never tried to make it any easier, and the technology platforms never like that. The home ownership industry never really developed the investment side of this. So they got really good at helping you invest in stocks, but nobody over here in real estate ever got really good at helping you invest in real estate. So groups like this forum, where entrepreneurs go peer-to-peer, learn from each other, very sharing and open environment to share great ideas among other entrepreneurs. But wouldn't it be nice if there was a professional industry to plug into to help? There really never has been. It's been us doing it ourselves,
Okay. So share some stats, if you could. How much is under management with you guys right now with Renters Warehouse?
22,000 doors. Yeah, so it's 22,000 houses across 40 markets that are under management. Our client base ranges that our average client owns a house and a half. All right. So we've got on the upper end of that scale, a dozen or so clients that are in our portfolio services division. That's folks that have more than 100. They have 3, 4, maybe 800. I think our biggest client's got 1,000 under management with us. But the bread and butter are the people that have the 1 or 2. And, our mission in life here is to make it good enough so that they want to go for a third, go for a fifth, retire with 15, that kind of thing. So that's where my passion lies, is in individuals that want to make a long-term pursuit out of this and get really good at it and help take some of the edge off with the management. But it's not boring. There are people who think owning rental property is a boring thing. Not if you do it right, right? If you do it right, it is very strategic, and you can be really good at it.
Yep.
And have that translate into wealth for your family.
Yeah. There's so many aspects of building a portfolio that require a different set of skills than just pure acquisitions. There's tenant management and property management and, asset protection and the whole wealth side of things.
Right.
So we could go down many different rabbit holes, but for the purpose of this conversation, let's keep it on like what's happening right now. And let's start in the micro and as to what are renters or landlords doing right now. And then let's zoom out a little bit and try to predict the medium and long term. So last week was April 1st. What happened with your portfolios? Did
Good question.
a lot of rents not get paid?
So we were obviously concerned about that, right? Because there were a number of people that ran for the microphone 3 weeks ago and said moratoriums on evictions, because the big bad landlord collecting the rent makes, that's mean and nasty to do something like that, like actually collect the rent. So we were worried that was going to create a wave of delinquency, and it actually so far, we're now at the 6th of the month. We've collected 84% of the rents for April. So out of 22,000 doors, 84% is in. That's only a couple of percentage points behind where we would normally be at this point. So we get up into the mid 80s in the first couple of days. Everybody who's on time, and then folks that are delayed and a little late paying their rent, usually it trickles in over the next 10 days. We usually collect 97% of all the rents within those first 10 days, and we're going to wind up, it looks like, in the 93% range. So that's not bad. We had down case scenarios and worst case scenarios planned out. Like what happens if, 30% don't pay? What happens if 40% don't pay the rent? That could be catastrophic for a business like ours. It certainly can be really painful. I mean, you think about when you have a business that the average owner, the average landlord that we manage for owns 1.5 houses. So that means most of them have one. They're counting on this income. Many of them are paying a mortgage with it. Many of them are feeding themselves with it. And so, if a tenant flippantly decides not to pay the rent, if they're in hardship and they lost their job, that's something different. We were worried about the people that weren't in that situation that would actually intentionally hold back on the rent. They're not doing it. We're reaching out to every tenant. They're paying when they can. The ones that lost their jobs are asking for payment plans. There is no indication that we could pick up on right now that people are being flippant about it. They're paying their obligations. So that's good news, right? We have I think we are the largest third-party property manager in the country. And the fact that most of our owners are relatively small means that that's a really good indication of what everyday people are doing, which is if they can, they're paying their rent.
Okay. What about next month or the month after?
Great question. So, I'll tell you some of the things that we've put together. So I don't know.
Yeah.
I didn't know until the first what it was going to look like here, and the first came through strong. Don't know what's going to happen. I know the stimulus is going to get paid out probably by the time May 1st comes along. That's going to help. We're all expecting. The stock market was up today because there seems to be some indication that the rate of growth is slowing. That was enough to get the stock market to pop today. If we get 2 or 3 weeks worth of the growth of COVID is slowing, that's going to be wonderful, right? And that's what I think everybody's hoping for as a best case scenario right now. We've been trying to look at historical comparables to this and try to figure out when the market seizes up, what does that actually look like, right? It may feel like it's seized up, but what does it actually mean from a data perspective? And what we found, I went back because I ran a real estate company with my brothers and my mom, but she was semi-retired outside of New York back when 9/11 hit. So we had 1,000 agents. We had 25 offices, a decent sized real estate company in the suburbs of New York City. And then when 9/11, when the terrorist attacks hit, our recollection was the market froze. September, October, November, nobody was buying a house. I went back and looked. It turned out it went down by 35%. The number of people that bought houses declined. Our business declined by 35% in terms of actual home sales. It felt like it seized up, but what actually happened, it came down 35%. And then it thawed out, and then actually 2002 was a good year. Went back and looked at the financial crisis 2008, right? Stock market's tanking, Bear Stearns goes belly up, the world's falling apart. housing's at the center of it, but if you look at the peak and the trough, it was down 35%. That number popped up again. That when real estate markets hit the skids, what actually happens is the number of people that actually make a move declines by about a third. We're now seeing at Renters Warehouse, the earliest indicators we have are tenants calling on properties, right? Because we have all these houses, we have several hundred that are on the market for rent. We didn't know, is anybody going to want to rent a house in April of 2020? We saw a decline off the peak of new inquiries, of tenant applications, showing requests, all those early indicators of tenant activity. It's down 35%. All right, so that kind of stuff always jumps out at me, right? It's scientific to a point, and then it's what is your gut telling you? When you start seeing what think I'm witnessing here is that when real estate markets get punched in the gut, they go down by about a third. And about 2/3 of people that needed to move or wanted to move are still going to do it. Right? So what I'm expecting is that the spring market of 2020 is going to feel a lot like the winter market of 2019 and 2020. We're not going to see a big boost in the spring. We're actually dropping and leveling off to about the levels that we had in January and February. So it's erasing the boost of the spring, but it's not evaporating the business in the quarter. I think I lost the audio.
Yeah, I'm saying that makes sense. At this point, I'm just going to open it up for questions. So you guys go ahead and try to stump Greg.
Please don't.
Yeah, Beaumont said, interesting insight.
I can prompt the conversation if you want, because we've got something else that we think is kind of guiding our plans right now.
Sure.
And that's the idea that if you look at the way recessions play out, usually they're this kind of balancing, this cascade of something happens. Okay. And this time it was the pandemic. 2008, it was, the bubble bursting and Bear Stearns bellying up. 9/11, before that, there's other recessions. You go all the way back to 1929. And the first thing that happens is the public's response to some action is they lose confidence in the stock market tanks very quickly, right? That's always the first thing that happens. You see a dive in the stock market. Then you have the human response to that is an erosion of consumer confidence, okay? And then you start seeing that play out where people stop spending money. They want to keep their powder dry. They're not confident. They lose their job, or they're not confident they're going to keep their job. They start holding back, keeping their powder dry. Next thing that happens is businesses begin to lose confidence. They see less people in the stores, less people on the websites, less people in the restaurant, less customers. They say, keep our powder dry. They start freezing on hiring and then maybe doing layoffs. Then you see home sales activity starting to slow down. Home sales activity slowing down eventually shows up in home price activity begins to go down. But all that stuff usually takes place over a year or 2 years' time. Stock market tanking, you see a few months later consumer confidence eroding. You see a few months later unemployment starting to tick up. Down the line, you see home sales declining. This feels like everything that would normally take place over a 9 or 12 or 15-month period is being packed into like 8 weeks.
Damn, yeah.
Right? So you see stock market tank, and then you see unemployment crank up like 4 days later, right? You see businesses doing massive layoffs. All this stuff seems to be compacted, which actually is good if you think about the fact that a recession is only ever half the story anyway. The recession and the recovery is the whole story. So chapter 1 is the recession, chapter 2 is the recovery. If a recession gets packed into an 8-week period, does the recovery also crank up? Like I'm hoping for, and I'm a hoper, right? So I'm hoping, like I don't plan to cook for myself till the end of the year. As soon as I can go to a restaurant, it's all restaurants, all takeout for the rest of the year. I'm going to spend everything, right? Like I wanted a car, I'm getting a car. I wanted a trip. So from the standpoint of you watch this volley between an event in the economy and a consumer response and an event and a business response, this events and response ping pong match is all happening in such a tight time period that the recovery should also be compacted. And that's where that V-shaped recovery conversation comes in, where if we can hold out and prepare, we're preparing so that we're lined up at the starting line, that when the gun goes off, when the green light goes green, we are so in shape that we're able to sprint ahead when things open up again and make up for lost time.
Okay. Yep.
That's how I see it too.
That's crazy how compact it all is.
Yeah, that's how I've been looking at it as well. It's just going to be like the same thing, but it's just happening really quick.
Yep. Matt Vbrock has a question. He's wondering what the impact of the $2 trillion stimulus package will have on the housing industry and inflation. I've heard that it's really not going to affect inflation that much, but I'm curious on your opinion on that, as well as its effect on the housing industry.
Well, it's when you say housing industry, you mean housing market overall, like the values of homes and the home sales, or the industry that actually sells them or builds them? Or But let me answer from the standpoint of the market itself.
Home sales and prices, it says. Yeah.
The stimulus is like, we're all getting a bailout, right? Usually other people get the bailout, so we're all getting a bit of a bailout here. My entire life, which is now getting long, I have heard about how government spending, deficit spending, is going to crash the economy. It's going to crank up inflation. And I've always bought into that because it makes sense on its face that if you borrow too much, you're eventually going to have a problem. Just hasn't happened yet. So it makes me nervous that we spend trillions of dollars. I like the idea that we're doing it, because who the heck knew what was going to happen if we don't really stimulate and fuel this thing? We're going to have a lot of work to do to pay this debt off as an economy. So I don't know. I'm not an economist. I can tell you that my entire life, economists have told me this kind of activity winds up biting us, and it hasn't really done that yet. Yeah. And so I'm glad that we're doing the stimulus. I think what's going to happen in the housing market, I'll go on record that I think we're going to see the only houses that are going to sell over the next 90 days are ones that sell at a discount. Okay? Except for the folks that are already in contract and have to follow through. But any new transactions that happen in the next 2 to 4 months are going to be transactions that happen at a discount, because the sellers that can hold are just going to hold. They're not going to take a discount. The sellers that have to sell or just want to convert their real estate into cash, and those people are out there, right? Look at the stock market. Somebody who owned a stock at this is selling it at that, and they're happy to get the money out. It's going to get reported in the media that home values have plummeted by whatever the number is, 18% in no time flat. Again, that would have taken 18 months. It's going to happen in 5 weeks. It's going to get reported that home prices have plummeted. They're going to love saying that, but I don't think that's exactly accurate. I think the only houses that sell during this period of time are the ones that are going to sell at a discount. That is not necessarily a reflection of the value of the market.
I totally agree. Yeah, I think we have a house that's just going to go on supposed to go on the market like in a week, and I'm thinking, oh man, that thing's going to just sit, because no one's going to buy it, a brand new one. I don't like, it's just going to sit. I try to be positive. And
you're not necessarily a motivated seller, so you're not going to let it go at a discount.
Yeah, because it's like we just bought it and rehabbed it, right?
But
I agree, there's motivated sellers that just want out because people are running off of fear, right? And the news only reports on the fear-based stuff. And so people want, there'll be motivated sellers, I think, everywhere in the next 60 days.
Yeah, so this is good news for investors and the people that we work with. There's just going to be more distress now financially more than ever. What is your take on the investor side of things at this point over the next 90 days?
There's definitely going to be an opportunity. And it's not, if you're willing to come up with cash for a house right now and somebody wants to convert that house into cash, you're a hero. Okay. We're not capitalizing on anybody's on the downtrodden nature of a situation. There are people that want, like there was a guy last week, had a conversation with somebody we've known for years, got a portfolio worth $1.4 million. He says, my wife is she's like, you idiot. I told you to sell these houses last year. You said, no, one more year. It's going to be a great economy in 2020. And you should have sold them now. You should have sold them then. You got to sell them now. He said, if I can get 7 figures in 3 weeks, I'll take it. Right. So he presented that to somebody, and we'll see if he does or not. But his reaction was very much like somebody who sold their Amazon stock. You know, the Amazon stock is not, that company's not worth less than it was 2 weeks ago, but the stock is trading less, right? Mm-hmm. So there are people, and this is a smart guy who says $1 million in 3 weeks, I'll take it, even though I could have gotten $1.2 million, $1.3 million. If I held out, I could have gotten $1.4 million. Just give me my $1 million, right? Mm-hmm. That was his attitude. He bought the houses forever ago. So there are people who, if you're showing faith and confidence in the housing market when a lot of other people are showing a lack of faith and confidence, you deserve a discount, right? And I think it may only be a couple of months of a window. I really believe that. Like it might be like making a lot of offers over the next few months if you believe what I'm saying. Now, if I'm wrong and we get another rebounds and COVID goes on all through the year, then it was a terrible bet.
Yeah.
But if you think it's going to pop, you could see a sharp decline in what you can get a house for no other reason by somebody wants out. And then it pops back up again, and you're sitting there with that 20% is back in your pocket again in the spring of 2021.
Okay. But for all intents and purposes, we're talking about buy and hold opportunities here. We're not talking about flips per se.
I think if you're going to flip, you should expect to wait until the spring of next year. In other words, because I don't know pandemics, man, you know, so yeah. Like you're talking to somebody who's making business plans and strategies that if they don't come to pass, then we're just hanging on a little tighter for a little bit longer. But I'm not betting the farm when I'm talking about right now. Mm-hmm. So I wouldn't bet the farm on being able to flip something in September. I would expect, like, I throw a renter in there for a year. It's not a terrible idea.
V-Brock, I know you had some opinions last week. We had a conversation about some speculation that you heard from other experts. Curious what questions you have for Greg.
Yeah, so Greg, this is Matt V-Brock. I actually had a conversation with a couple lender friends of mine. One guy I talked to in particular last week, he works both in the RMLO side, you know, working non-QM loans for owner finance transactions, but he also primarily does a lot of normal retail loans as well. And this is the kind of guy that just never freaks out about anything. And I called him up and said, hey, you know, I was trying to look to put a different type of loan product together for my investing. And he's like, man, good luck with that, because he's like, we just got reports thinking that, you know, the economy is going to go to, you know, it'll bounce back relatively quickly, but possibly, but just if this thing gets worse, he's like, we're looking at possibly 31% unemployment over the course of the next 6 months. And so he said, you know, this quarter is going to be rough, but wait till the next 2 quarters. It's going to be even harder with the recovery. And I'm interested to hear kind of what your thoughts are on that in terms of, are we really headed for a depression, you know, from all the news that's kind of going on right now with the government and what they're thinking, or, you know, do we really think it's going to be like a rubber band effect that's going to pop back fast?
That's the $24,000 question, right? So as I said, I'm not betting the farm on a fast recovery here. Okay. We're planning for it because we don't want to get caught flat-footed, but everything we're doing is stockpiling cash right now, pulling back on marketing, the things that the business can do to keep its powder dry, because what you just described could be the case. I keep reminding myself that all the things that were real about this economy were great last month. Okay. Mm-hmm. Unemployment was genuinely low. Consumer confidence was genuinely high. Businesses were genuinely bringing in earnings, right? The unemployment rate going to 30% is not, when I say not real, it's obviously real to the people that get laid off. I'm not definitely trying to sound like I'm underplaying it. But when I say it, it's artificial. It was inflicted on us by something that wasn't an economic factor. It was it's something unforeseen, and as soon as it's gone, things should snap back. More similar to a rubber band than some. So, like, as a company, does the restaurant who fired everybody stay closed after he's allowed to open? She's allowed to open? No, they hire everybody back if they can. Yeah. Right. Do the stores that furloughed, retail stores furloughing people, do they hire them back when they can to try to make up for lost ground? I know some of them aren't going to be able to withstand it and wait it out, but everybody that can is going to.
Yep.
So that's a really, really ugly worst case scenario. I mean, worst case is zombie apocalypse, right? But worst case from the standpoint of 30-something% unemployment that sustains for a period of time because the businesses actually go bankrupt and fold up. That is certainly conceivable. I don't think it's going to happen.
Mm-hmm.
I don't.
Yep.
Hear that. What about the wave of, what do you expect foreclosure activity to be and loan modifications after all this is said and done, once the government says, okay, we can't provide any more stimulus to you guys, and the servicers are just like, okay, you guys got to start paying us, now, or otherwise, we're going to go insolvent. I mean, what happens at that point, and what do you foresee happening with, borrowers not being able to pay, because maybe they still don't have a job or something? I mean, what does that look like?
Yeah, it's back to the same thing, right? So if this does ride the way that a lot of credible experts say, that the virus peaks and then the virus begins to decline, I think I look at what's happening right now. Okay, so it was very interesting that last week something unexpected happened, which is that the White House announced 100,000 to 250,000 deaths, right? Which is not downplaying anything, right? That was definitely a sobering number to consider. People seem to appreciate hearing a really ugly case scenario, even though it was really painful to actually hear that. Now they're telling us they were using the word horrific about the way this week was going to be. So they're setting us up right now to expect announcements of death rates throughout this week that are just mind-boggling, and maybe into next week. But they're also setting us up to expect that it's going to crest. And the stock market today popped 1,000 points because there were some indexes that came out that indicated that the rate of growth of the infections was decline. The rate of growth was declining, painting this picture of that chart that's starting to crest and go the other direction. So it all depends on that. I mean, if they're wrong and we wind up with everybody staying away from each other, seems to be obviously the most important thing right now. And I think telling everybody there could be 100,000 to 240,000 deaths was about scaring everybody into their damn houses. Don't go to parties, stay in. So I have no idea. Like anybody here does, we don't know. But if what is being said is a possible outcome, that this thing begins to crest and play out, what I really believe is that if that happens, let me try to say it concisely. If this thing crests and goes the other direction over the next couple of months, I think we're going to have the party of the century. Okay? I think the economy is going to snap back hard. I think people are going to go out and they're going to spend money. This is going to be in the distance very, very quickly. And as I said, the recovery is going to match the speed and ferocity of the recession and how fast it came on. Beyond that, I have nothing to say. Meaning, if we wind up being in something that we've got cases and cases and cases, we're in September, and we've got millions of people that have this, then no idea. I'm glad I got a lot of dry powder, and I'm glad that I'm a boring conservative investor overall. So I wish I had a better answer for you, except that, if things go the way I'm hoping, we as people are going to respond in a way that's as aggressive as the downturn was.
Good deal. I appreciate that. Yeah, I think it was the biggest reason I was asking that question is in terms of trying to figure out, okay, positioning, for the future in terms of what kind of motivated sellers to go after, right? Because I know that like right now, at least in our space, there's a lot of conversation about, now just, go driving for dollars and go after those ugly houses as much as you can. But the way I view it is that there's going to be a lot of houses that aren't necessarily ugly, but there's going to be a lot of people that are going to be in financial stress and need help, right? And so aside from, the normal landlords and stuff like that, what other kinds of sellers should we be focusing on to help, and coming at it from that servant approach, to kind of target that message of, hey, you're in trouble with everything that's going on, we're buying, here's the different options that we can give. I think that there's going to be more types of people out there that maybe we're not thinking about right now or even targeting that maybe we should. So I'm just trying to get creative with who should we go after?
That's a good question.
Or put another way, how do we keep making money over the next 90 days?
Yeah.
Well, one of the things that Leanna, I think, said before, that she's got a house that's about to come out the other end of the pipeline, and she, doesn't know how excited she is about selling it at a discount. And this definitely highlights the idea that if anybody in this business did keep a bigger proportion of the properties they got their hands on as rentals, that shows real well right now if you've got income coming in from these things. So I look out there and I think, okay, so if I'm a family and I can't pay my mortgage, I don't want to pay my mortgage, the idea of selling my house at a discount but being able to stay in place and rent it is attractive. I think it's interesting that what Open Door and Zillow offers and everybody else kind of showed the world, that making instant offers and giving people an easy way to sell their property is attractive. They all stopped buying, which also tells you that when they said that their business model didn't depend upon the properties appreciating, that's questionable now, right? They may have paid too much for those houses, and this really was a gain market share with a new home sales concept. Even if you're losing money, it's okay. But it put it back. This industry, your industry, was the original, we pay cash for houses quickly.
Yeah.
Right. They came along and did it online, but I kind of feel like that old school tried and true stuff is probably going to work again, because at least one band of competitors are out of the market temporarily.
Mm-hmm.
So I don't know if you have to reinvent the wheel. You may have to just dust off some of your tools and get them flying again.
Yep. There's a lot of talk in the space about just getting good at creative financing, and things like taking over mortgages and selling on a lease option, and just more creative working around the bank type of strategies. And which is probably a good segue to what you think is going to happen with the mortgage industry, and how is that going to play out?
Well, it's interesting. I've heard some economists who work for the mortgage companies talking about 25% defaults. And I don't know what it is about economists that they just are so turned on by the worst case scenarios. 25% defaults. In the middle of the housing crisis, I think defaults got to 6% 10 years ago, right? So 25% is, again, that's them modeling 30% unemployment, 25% defaults. The last question and this question are both tied together. I believe that you're going to see that you don't have to get that creative right now. If you have the means to put offers in front of people, you're going to find people that the answer was no not long ago. The answer is yes now.
Right.
That's an interesting point, that we're finding this across our organization, that people who their needs have changed very drastically. I'll give you $200,000 for the house. No way. You make that same offer today, I'll take it. Right? I don't know that you need to get creative. I think you need to get fast. Right? That's what we're doing. We're not really changing much of what we do. We're outworking our competition. I've been telling my people that there are people in our industry that are just going to take the time off. They don't think. Yeah. That's why I'm harping on this. It's only down 35% in terms of activity. 65% of the pie is still out there, because I want to persuade my people that you can make your numbers if you just outwork. If you do nothing different but just outwork everybody else or outwork some of the competitors, that's enough, right? Like, it's 9 o'clock. Are you at the desk, or are you still finishing up your coffee? Are you rolling out of bed? It's noon. Did you take a 2-hour lunch, or did you take a 45-minute lunch the way you always do? It's 5:05. Are you back in front of the couch again? Like, if we're just putting in a typical 40-hour work week, 50-hour work week, I think is going to be a competitive advantage right now. Reaching out to a lot of people as a solution provider. I've got cash. I want to buy houses. I can't pay retail, but I can give you cash for 75% of retail and close in 3 weeks. Make that offer to 100 people who said no back in February. See what they say now.
Mm-hmm. Time to hustle is the general message that we're putting out too. It's interesting. I mean, I know we're not downplaying the negative
aspect of this crisis, but what are you and the Renters Warehouse team most excited about right now?
Most excited about? Interestingly, the instinct that I had, the response that I naturally had, the response that I have a boss. I haven't had a boss in a long time. So Kevin Ortner is the CEO of Renters Warehouse. He's my boss. His instinct, the leadership team. This is an opportunity to show the people that depend on you that you can be dependent on. Right? Like, we're not sweating. We're not showing fear. We're making contingency plans. We're being realistic, but we're also wrapping our arms around our people and saying, like, look, you can feel good about the fact that this ship is easy to steer when the seas are calm, right? We got some swells out there now, but we've got our hands on it and we feel good about it. I'm excited about watching the way we're performing during a stress test.
Yeah.
I know we're doing well. I know I have a lot of friends in a lot of businesses, and I can tell you that I can count on 2 fingers how many people that are business leaders, not big. Most of my friends, smallish businesses, right? I can count on 2 fingers the ones that I think are handling it poorly, meaning they're showing fear. They're just saying there's nothing I can do, and they're not supporting their people. They're not staying on top of what the government is putting out and making sure everybody knows about it. We're also wrapping our arms around our customers, trying to show them, like, you're with a good outfit here. All right. We're putting information out to you. So I guess I'm excited. It's a philosophical thing. I'm excited about the fact that we're doing well under pressure. We're showing grace under pressure, and everywhere I look, I'm seeing a lot of that, which just reinforces the idea that people in business, they know how to handle getting punched in the gut sometimes, and keeping their chin up and staying tough and staying mentally strong and emotionally strong and hanging on to the wheel, through the turbulence.
And at the end of it, you see who made it through. You see how you strengthened. You see how your strategy might have shifted for the better, and you come out stronger. Anti-Fragile is what it's called.
Anti-Fragile. I never heard that. It's pretty cool.
Yeah, it's a book where things that try to destroy you actually make you stronger. And that's what the opportunity is for business owners right now. What are you guys recommending to your clients right now in terms of, do you buy more, hold on?
We don't have that kind of gumption just yet.
Yeah.
We have our portfolio services division that deals with institutions. Okay. And those are the buying and selling customers that I personally come in contact more often. There's layers between me and our retail customers. Okay. What's happening on the institutional front is that there was a number of new investment firms entering single family rental for the first time. All right. So the first wave, Invitation Homes and that whole crew, this is a second wave. And it's being driven by the fact that because the first wave proved out the asset class, and the asset class has now had multiple years to season, and they're paying dividends on their stocks, and they're paying the coupons on their bonds, and it's manageable and it's good, right? Their masters, the pension funds, the insurance companies, the sovereign wealth funds, the super high net worth families, the deepest pockets of capital are looking at SFR as a place to diversify and put some money. And so the way that plays out is some insurance company has billions of dollars allocated to their different providers, and those providers are coming in and saying, listen, we've got you fully allocated in multifamily, office, industrial, retail. We're now doing an SFR fund too. Do you want to throw us a couple of $1 billion for that? And they're getting yeses to that. So existing players in large commercial real estate are now spinning out an SFR fund because they realize that it's actually another food group in commercial real estate. They all hit pause on the same day 2 weeks ago. All right. Like, we love it. Pause. All right. Not stop, but pause. We're staying in close contact with them because we know that some of them, and it's already begun to show up, have said, okay, we're off of pause. Take 20% off of what our buy box was before and go to town. It's like I was suggesting to you, right? Like, go make a lot of offers to a lot of people at 20% off, see what you can get. So they feathered the gas a little bit. Like we literally had somebody who said, go, no, wait, stop, 25%. No, wait, 20. You know, like they don't know. Yeah. These conversations go from I feel very confident about my optimism until I see a story that says, what if we get a second wave of COVID? Oh shit, this could be into the fall, pull it back. So to everybody involved, we're basically, all we're telling them is like, you're invested in an asset class that is conservative. You're invested in an asset class that is essential. It's shelter over families for the most part. Now that we have a sense that people that can pay their rent we're trying to be reassuring on that. And we're simply riding the storm out. When the time comes that they say, okay, it's passed in the state of Florida, it's passed in the state of Texas, we're going to say pedal to metal. If it's passed, now it's time to buy and eat with both hands, because this will not last either.
So one good question that Matt asked was, how do we get some of that money, the institutional money, and bring it down from Wall Street to Main Street?
That's a good question. The folks that we're dealing with, they find their way to us because this kind of characterizes them pretty well. They're 4 people with a bag of money in a conference room in New York. All right. They do not want to manage property. They need sourcing and they need management, and they don't want to do it the way Invitation Homes did it, which is to build an entire business around the infrastructure. So they always wind up, most of them find their way to us because we do sourcing and we do property management under one roof. And so as they're looking for vendors to help them, service providers to help them, they end up with us. So I don't know how I think the best answer to that is consider what I just said, that this asset class is attracting a lot of attention. I don't know about a $2 billion pension fund, but I think about a high net worth family. I think about the fact that there are people out there that right now are wishing they had more money in real estate than they had in the stock market.
Right.
And if you have not syndicated before, put together your first syndication deals. If you have syndicated before, add a comma to your next syndication deal and see if by virtue of being able to represent the asset class and speak about the virtues of the asset class, the stock market is a very, very good contrast to real estate right now. And tell them a story like, you don't want to go back there. These guys lose their heads, right? We don't lose them. You know what happened in the real estate market in the last 2 weeks? Nothing. It just slowed down a little bit.
Yep.
So, but that's, again, I'm in the rental side, guys. I don't do flips, and I can't add a lot of value on the flip conversation per se, but I would definitely recommend that anybody that can accumulate more rental property over time, and as a byproduct of what you do, I know a lot of your folks do that.
Yeah.
They, keep some over time when the opportunity arises. I know it's real attractive to get the cash back out, make the next deal, but leaving some of that stuff in, there are people that want to put their dollars in the hands of people that know how to do that. And if you know how to do that, maybe you just elevate your game with an extra comma.
Greg, a question kind of follow up to that then is, what's most important to those high net worth individuals and those pension funds and the big money managers? Is it preservation, more preservation of capital, or is it, the actual big growth in the double digit kind of growth or even triple digits?
I think that's
what for steady return.
Sorry, finish your question.
Or were they just looking for more of just a steady return?
I think overall the generalization is that right now preservation of capital is looking pretty good. And I don't agree with them about this point. Most of them have wanted to buy yield and have thought of appreciation as being just kind of a bonus, cherry on top. And it's not supposed to be a cherry on top. You're supposed to choose your markets wisely because you want to get outsized appreciation to go along with your yield. Because if you put leverage on an asset that generates income and appreciates well, you wind up in the low teens without breaking a sweat, right? Without taking much risk. But I do believe that right now, the most compelling part of this is that if you're not allocated in housing compared to commercial real estate is an important distinction, right? Commercial real estate right now, I would not want to be in retail. I would not want to be in hospitality. I wouldn't want to be in office. Everybody I know says, I don't want to go back to the office anymore, right? I like working from home. Yeah. Everybody I know who has kids that aren't under the age of 4, right? But like every one of those commercial real estate asset groups are susceptible to economic swings. We're based on population, right? Population is growing. People want to live indoors. That's not going to change. And so I think this gives everybody here a chance to reveal the spectacular nature of an asset class based upon population in the U.S. in contrast to the stock market, which is an obvious one, but also in contrast, like, yeah, I own a bunch of triple net lease for whatever, Rite Aids. Great. But Rite Aid, you know, I mean, they haven't shut down because they can't shut down, but, you know, how's their business doing right now? And do they consolidate stores on the other end of this? Right? This is an opportunity to show that this is an asset class that has never been professionalized to the degree that capital sources wanted it to, but it is now.
Yep.
Right? And to the extent that you guys and gals accumulate portfolios or help other people accumulate portfolios, the existence of bigger fish down the food chain that didn't used to exist, right? Large players want to buy those portfolios. That wasn't the case a couple of years ago. So it's this image of a small guppy and a bigger fish behind it about to eat it, and a bigger fish behind that, all the way up to a big monster on the end. If you don't have the big monster on the end, you don't have the food chain.
Yeah.
You've got the big monster on the end now. So you can play different roles as those smaller and medium-sized fish, whatever you're up to, knowing that you've got an exit if you build the kind of stuff, the kind of portfolio the bigger players want to eat.
Is Renters Warehouse on the food chain for folks that have smaller portfolios that they might want to sell?
We don't buy property right now. Okay. So we have clients that do, but we don't. We frequently say we really need to get into that side of the world, right? We know a lot of people with capital, but we're in the process of building a national brand for single family investors. And so there's so much to do on that front that we've not actually come around to doing it. So the answer is no, we're not buying. Personally, I am, but as a company, we don't buy. Okay.
If someone does have a portfolio, we can send you an email, and maybe you or some clients might be interested.
Yeah, for sure. We definitely have clients that are interested. Again, they hit the pause button on me, but they're going to unpause that at some point.
Yeah.
I think it goes back to the point that any piece of real estate, portfolio or otherwise, right now is not going to move unless someone's willing to take 20% off of market value. Mm-hmm. So if you can hang on to it, it's probably the right move.
And also so I guess, could you help a lot of my clients like move properties at that if they did get it for a discount?
Yeah, well, that's one of it's a good question. So as we hook up with these larger players that have hit pause, before they hit pause, we were pitching them this idea of multi-channel acquisitions. That's portfolio channel, new build channel, and new renovation channel, meaning newly renovated houses from folks that know how to find a house in dilapidated condition. They can renovate it efficiently. They can make a profit on it and deliver 8 of these a month, right? Like here's a house they are very excited about tying up with suppliers, as we call them, right? A local player in a local market who has the capacity to bring these things to fruition is happy to make maybe less than they would have otherwise made if they sold at retail, but still make a healthy profit, but do it with knowing they've got a ready exit.
Yeah.
5 of these a month, and they know exactly what to go find. That's actually a good opportunity that we could be working together with folks on this call. That if you want to be a supplier in the supply chain to some of these larger fish, we could talk.
Well, we got some of those people on the call right now, for sure.
Yeah, that was actually going to be one of my questions in terms of the supply side of things. I mean, obviously with houses and turning them into rentals is one thing, but what about those of us who are more in the owner finance space like myself, where we come across deals all the time where, maybe a seller has, they paid down about 50 to 60% of their mortgage, and they've got, and they basically just want to get cashed out in some way, but they're set on their price, right? So let's take a house that's $100,000 and let's say they owe $50,000 on it. But they wanted me to buy it from them for $80,000. Well, I can do that all day long. I can turn around and sell it with owner financing in place when I wrap the underlying loan from a private lender that I put in first lien position to buy out the seller's loan, basically. and I can get a second lien position from the seller, where I'm paying them on their equity over a certain amount of time. And I'm giving that first lien position private money lender a good solid 8 to 12% interest only payment for however many years they're okay with getting it. I've never seen, I've been looking for a loan product that matches up private money with people like that who are willing to allow us to wrap those loans and just get that preservation of capital and earn that interest like you were talking about. I could come across probably 5 to 10 of those a month easy, and we could turn those into, really good solid deals for people, but I just haven't been able to find a loan product like that. Do you guys have anything that, people who are looking to loan money in that type of a situation?
You know what? Not really. And the reason for that is that I'm a little bit too lazy to be able to figure out what you just described. We're going after people that want to buy the house and either pay cash or get a more traditional piece of financing on it. So there's a big enough market out there, people that are doing that we're going after that business, and it's not as profitable, but it's for our model, it is. So I actually am not going to be very helpful on that front, Matt.
No worries.
Hey, Greg, do you have any good context in the syndication world as far as attorneys? I'm personally looking for a good attorney that can help put together syndications. Do you know of any?
Nah, again, it's outside my wheelhouse, so I don't want to
Okay.
comment on something that I'm not really familiar with. We've always recommended that people own in their own name, have the freedom to buy what they want, sell when they want, and so we keep focusing on that, and it doesn't put me in a situation where I know those attorneys.
Yeah. Okay. I'm also trying to think of, well, I'll let you guys, just in the interest of time, we can start wrapping it up with any last questions. Greg, this has been super helpful. Definitely getting the wheels turning. Any other questions you guys have? I know we got some rehabbers on here. I know we have some wholesalers. We have some folks that are hopeful and some folks that aren't so hopeful. Go ahead and ask some questions.
Hey, this is Stuart here.
Let's do it.
Greg, I'm here in South Texas. I'm in Corpus Christi, and I've heard. I'm not familiar with you guys, but I've heard. I guess maybe what you're talking about, like institutional buyers entering the market from some real estate coaches I pay attention to that are in Houston. And it sounds real similar to, like, I guess, the big fish of what you were just, your last analogy on house buyers, how that in the single family world, there really wasn't that institutional buyer that was just real active. But I guess one question I'd be curious on is, I mean, as major markets, Houston, Metroplex, Austin, places like that get pressure. I mean, do you see some of those institutional buyers going into secondary market or I guess next tier down type population centers anytime soon, or is that's
That's happening now? Yeah, without question. That's a great question. So the first round of institutions, they were funny because you would see them on a panel at a conference, and they would say, after having analyzed every scrap of data known to mankind, and putting all the best brains from Ivy League on it, we decided on Atlanta, Tampa, Jacksonville, Charlotte, Dallas, Houston, Nashville, and Houston. Right? So they all decided on the same places. There was a lot of groupthink on that. It was because of the big job growth cities in the Southeast, right? Many of the new players now are realizing that because they don't have to they're not trying to pile on in a few markets where they're going to own their own infrastructure. They're actually coming to us and companies like us to be able to hire infrastructure that allows them to buy in more places. And they definitely see, like, I'll give you an example. We have conversations all the time of what is the next Dallas, meaning different markets evolve and mature in different paces. You pick any metro area and you draw the circle around the metro area of whatever it is, 40 miles, 60 miles, whatever the outer ring suburbs are. And you can identify different suburbs that have developed at a different pace than others. Some were more expensive than others. Some have better schools than others. Some, it's lopsided. All right. So in any given metro area, there are usually suburbs that are later bloomers, right? Same exact thing is true of MSAs, secondary and tertiary MSAs. Like, is Corpus Christi a comparable to Houston 15 years ago? I don't know. Maybe a story can be told there, right? I know that Oklahoma City is a decent comp for Dallas 20 years ago. I know that Chattanooga is a good comp from Nashville from 20 years ago. I know Colorado Springs is a good comp for Denver. I believe that Columbia, South Carolina is a good comp for Charlotte. And so that whole concept of show me the migration trends and the employment trends that have made this city become unaffordable. It used to be a great job capital, low cost of living. Oh, wait a second. The quality of life is still good. The jobs are still there, but the cost of living is not low anymore, right? Real estate and taxes have gotten too high, so that market's not attractive anymore. Show me something else that shares a lot of the very same fundamentals, but is just a later bloomer. And that story did not resonate at all 5 years ago, and it resonates a lot now. In fact, I don't even have to tell the story. Most of the clients that are coming to us are actually looking for great second cities, and Corpus Christi is a great example of one. It's Texas, right? Texas is hot as a pistol, all right? Texas but I mean, what kind of a yield can somebody get? Can they get a 6.25% net yield in Corpus Christi right now on a house in a decent school district?
Well, if I'm looking at it as a rent house, it has to be like, I'm looking for more like an 18 or 20%. So yeah, you definitely can.
You can definitely get a 6.5. So we've got a client who wanted to buy anything, anywhere that was a 6. And we said, anything, anywhere? And they said, yeah. Then we showed them stuff. They said, I don't want that. Why? Because of this. It's like, well, it would be nice if you could tell us what anywhere actually means. And they dialed it in for us. But so the short answer to your question is that every square inch of this country is on the table. And the second tier cities right now, I think, are becoming very popular. And there are entire investment funds that want to make their whole portfolio in the Chattanooga, Corpus Christi, Columbia type second tier cities and stay away from the ones that they think are oversaturated by the bigger players that came before.
Okay. Yeah, no, that's cool to hear. I really, you definitely answered what I was trying to ask.
Good. Thanks for asking.
I think this conversation is going to spur a lot of mini renters warehouses to pop up.
Okay, good.
All over the country. Any other questions, guys?
Hey, Greg, what's your take on the Florida market?
Take on the Florida market. I have thought for a long time, and it hasn't changed, that the migration from the Northeast to Florida was the thing. Like, when Florida was in a tough spot 10 years ago, it was just very clear that that was a short-term pain inherent in a market that had long-term gain, right? The analogy that I used on Florida 10 years ago was that, like, if you had two forces of nature, both of them very powerful, a forest fire, which feels like the most violent, powerful force of nature you could get. But if it collides with a glacier, a slow, lumbering, like unoffensive and unintimidating force of nature, the glacier still wins, right? The glacier is people getting out of New York, Boston, DC, people getting out of Ohio, getting out of Michigan, getting out of those colder places down to a no income tax, warm climate.
Yeah.
That's what put out the fire 8-10 years ago. Whatever fire we have right now, I mean, they have more electoral votes than New York does right now, and there's no sign of slowing down. And all these, I look at places like Lakeland. I love Lakeland because Tampa and Orlando, great cities, maybe overbought by the big players, but Lakeland's right in between. And like, if you draw 45 mile, 50 mile, 75 mile, like an hour and a half commutable distance, it overlaps in Lakeland. There's so much interior Florida. There's even coastline Florida on the northwest side of the state that's practically rural still, a couple of miles in from the coast. So I think Florida's got a massively long runway. I'm real optimistic about it because the fundamentals are all completely intact. Even if there's a flame up right now as a result of this coronavirus thing, all that's going to happen. Great example. If there is a flame up, if people think that Florida real estate is going to collapse, everybody's getting the hell out of New York after this. Where are they going to go? Right? Like I used to live in New York. Everybody I know is like, I can't believe you got out of New York and got to North Carolina before this coronavirus. Like, that's not why, but I got to admit, right? New York is showing a lot of people are going to leave after this. So I think Florida's going to be the main beneficiary of that. So I think Florida's great.
There you go, Phil. Keep doing deals.
What part of Florida are you in, Phil?
In South Florida, so in the Palm Beach, Broward County area. So, but I just put a house under market 2 weeks ago for a flip I did in Port St. Lucie.
Okay.
So that's under contract, and right now I'm still getting the retail price, so counting on this closing.
Now, as you head in from the coast, you hit the Everglades eventually, right? But what are the prices like? What's the market like in the innermost part of that Southeast Florida market before it gets to the Everglades?
Well, if you're talking about Belle Glade, Palaca, and all that, it's very cheap. I mean, that's for sugar country and others out there. So that's very cheap. High. I'm going to say high rental markets. High, cap rates and stuff, and lower prices. But as you start getting towards some of the western cities, those are very expensive. And then in the middle, there's a little bit cheaper. And then as you get to the coast, it's very expensive.
Right, and that's kind of follows the same. Like when I talked about a metro area and how when you get to the outer ring suburbs, some of those outer ring suburbs develop more slowly. In Florida, it's the interior, right? So the coastlines tended to be more expensive, and the further you got away, like clockwork, the values declined. But you start to see companies moving a little bit further away from the coast to get a better deal on rent, thereby making those jobs more easily reached by people that are a little bit further into the interior.
Right.
And when someone's getting out of New York, they're trying to get a halfway decent deal. They're not going to find it in as many places around the coastline. So I think there's a lot of room all around this country for continued infill of population, which means demand for our product.
Yeah, agree. Thank you.
Welcome.
Just a quick follow-up. I know it's unrelated, but do you ever have any insurance issues with insuring properties, insurance getting too expensive in any of the markets? Like for Florida, it's getting very pricey, and it's harder to do for single-family homes. So my cost of capital my cost for insuring has dramatically gone up in the last couple of years.
Yeah, we anything coastal, Carolinas, Florida, Texas, any place where there's a hurricane history and a flooding history, we've had the same kind of issues. So I don't have any magic solution to that.
Greg, I got a question for you in terms of what markets, especially like in the Midwest, are you seeing that have the most stable cash flows, good, solid, jobs with multiple industries? I'm kind of looking to expand outside of Texas alone, just to go into more of those, really stable cash flow markets. Which ones would you recommend?
I like Kansas City. It's interesting when you go to these places that I haven't spent much time. The numbers, the appreciation rate long term is a great indicator of how that market performs over time through different kinds of economic circumstances. The rental disparity with price and what that turns into for a yield, all those things are key. And then you talk to the people that live there and you get a sense of the cultural vibe of the place. And that gives you a sense of the resilience of the place. Like Kansas City, people that I've met in Kansas City are certain that Kansas City is the center of the universe. Like they love Kansas City. I've seen the same thing in Minneapolis. I've gotten to know Minneapolis very well. I'm like, why do you guys live here? It's 27 below. They're like, oh, you got to see it in the springtime. It's beautiful. I like Pittsburgh a lot for that reason. If you were going to leave Pittsburgh, you would be gone by now. All right. And they have held on through the erosion of their manufacturing base. And now they're coming screaming back with the energy sector. Cleveland is benefiting from manufacturing base erosion being replaced by components of auto manufacturing. I love So everything I just named, any place that you get in the Midwest that had a brighter past and a little bit of a dimmer middle and now a brighter future are exciting to me, because the yields are very strong because the prices have not kept up with the rents. The rents have kept escalating because the demand for housing is escalating, but the prices haven't caught up yet. The rents are almost ahead of the values, which means you can catch a place like Akron, Ohio, or Kansas City, where you're picking up. Kansas City, the yields aren't that great. But like Akron, Cincinnati, where you can catch the yield and then maybe even catch where the appreciation has been 2% on average for years. Maybe it goes to 4 because those places are becoming more popular. But I love trying to figure out, once I understand the hard data and the numbers, why do the people who are there stay, and why are people going there, and is that going to continue? And that feels like a long-term place to set up shop.
Awesome. And where are some of these places that you're getting your numbers and your data from to really kind of dive into those markets and do your underwriting to figure out which one's going to be the next one to go to?
Well, we buy all that stuff and put it up on our website for free. So in all the markets that we're in, if you go to renterswarehouse.com, you can do a search of MLS listings in all of our markets, and all those analytics are there. If it's a market that we don't have MLS listings, you can open a free account. You could put your own properties in, upload them in there, or key them in manually, and those analytics will get pulled down, and it's all free. So we built that stuff when Own America was dealing with institutions back 5-6 years ago. We got our hands on and got pretty comfortable bringing in all these different disparate data sets and turning them into data visualization and analytics. And then when we hooked up with Renters Warehouse, we decided to make them all public facing and free, and with a pretty transparent intent, which is we want everyone to love us and then do business with us at some point, right? So we give away all the data, and so please, Kansas City, St. Louis, those are both up there. Minneapolis is up there. I'm not sure if Detroit is. We don't have much action right now, and we don't have any operations in Ohio, so I'm a goose egg there. But you could take property data from there, put it in, and see the analytics for free.
Awesome. Thank you. So maybe now's a good time to do like a plug for you guys. Like what all do you guys offer from the standpoint of property management, and who could we be in touch with to help us out with that if we were interested in work with you guys?
Well, thanks for asking. Yeah, so we're a property management company. We charge a flat fee. It's anywhere from $99 to $129 a month, all inclusive, and a month's rent for tenant placement. So we're a full service sort of white glove property management firm. The magic of what we're trying to pull together now, that the clients who use us for acquisitions and dispositions and property management in between, is that there's a level of accountability there, that we help you find the properties, we then manage them, we help you sell them eventually, and we've got nowhere to hide, right? If we sold you a loser, we're the ones who are going to suffer as a result right along with you. But that's our game. We're trying, internally, we talk about trying to make owning rental property easy. It's not easy. It's a pain in the neck, all right? But we're trying to take as many of those pain points away by letting you do as many of these things under one roof. And we're trying to improve every day. So I appreciate you asking.
I love that. Thank you so much.
Amazing. So what's the high level summary of Chief of Strategy? I'm curious about that title, then we'll let you go.
Where did the title come from?
Chief Strategy Officer. Yeah. Like what is your responsibilities?
Okay. Yeah. So I'm responsible for the development of our customer facing technology. Right. So the website and all the things I just described, all the technology around what our owners get in terms of like the kind of things that we have in the roadmap that are going to be developed later on this year are going to be exciting, because if you own a portfolio of one or more and we manage it, not just the current information on your rent and your maintenance and everything else, but the value of the property, the ROI of the property, the changes in market dynamics related to your portfolio, all that public facing stuff. So the whole online experience I get to drive, but also the offline experience. We've got 200 real estate agents out across all of our markets, and they report up through a management team and into my department also. And so we train them to be the physical embodiment of what's on the website. Right? So as an investor, I do my research, I do my planning. I want to talk to a human being who's actually intelligent about this stuff. That's our people, right? You know, most realtors don't know this stuff. Okay. So we have licensed real estate brokers who do. And that's the combination. So chief strategy is all about trying to implement this idea of a real estate brand for single family investment, complete with the tech and the relationship and the long-term management. So that more people that are doing this the hard way do it the easier way, and a whole lot of people who aren't doing it at all start doing it because we've taken the pain out.
Love that vision, man. Making it easier for people. That's what InvestorFuse's vision is too.
Yep.
When it comes to the acquisition side of the sourcing side of things. Well, in the interest of time, we'll let you go. You've been super generous and very insightful for people.
Thank you.
This replay is going to get posted up probably on other avenues. So I hope to point some more inbound your way. And yeah, this was super helpful, man. I really appreciate the short notice getting on here. I know it's kind of wild times, and you're much appreciated, man.
Well, thank you. I really appreciate the time, and it's been great to meet you all. And let's all hang tough, right? This thing will be over soon, and we can look back and know that we handled it like Vikings.
Yep, exactly. Let's hope for that party you were talking about earlier.
Exactly.
All right, everybody. This has been today's episode of the 80/20 Academy Q&A market update with Greg Rand from Renters Warehouse. Thanks again, man. And everybody else, you have a great rest of your evening. Stay safe.
Thank you. Yeah, for sure. Good one. Thank you all.
Take care.
Guys.